Supermicrocomputer has just taken another strategic step deeper into the rapidly expanding artificial intelligence infrastructure race. The company recently announced that it signed a three-party memorandum of understanding with SK Telecom and Schneider Electric to jointly develop modular AI data center solutions designed specifically for the next generation of high-performance computing workloads. While memorandums of understanding are not binding contracts, they often signal serious collaboration plans between major industry players. And in this case, the partnership brings together three companies that each control a critical piece of the AI infrastructure stack. Supermicrocomputer contributes server and computing hardware expertise. SK Telecom brings telecommunications and data infrastructure experience from one of Asia's largest technology companies. And Schneider Electric contributes its deep background in power management, energy efficiency, and industrial infrastructure systems that are essential for large-scale data center operations. The focus of this collaboration is modular AI data centers, a concept that has gained a lot of traction recently as companies look for ways to deploy high-performance computing capacity faster than traditional data center construction allows. Traditional hyperscale facilities often require years of planning, construction, and permitting before they become operational. Modular systems, on the other hand, can be assembled in prefabricated units that are manufactured, shipped, and deployed far more quickly. For companies racing to build AI capacity to support training models, running inference workloads, and processing massive data sets, deployment speed has become one of the most important competitive advantages. By targeting faster deployment timelines, lower infrastructure costs, and flexible scalability, the partnership between Supermicro, SK Telecom, and Schneider Electric is clearly trying to address some of the biggest bottlenecks facing the global AI infrastructure build-out. The announcement arrives during a somewhat mixed period for Supermicrocomputer's stock performance. In the most recent trading session following the news, the company's shares moved noticeably higher, posting a one-day gain of roughly 6.42% and lifting the stock price to about $32.65. Short-term movements like this often reflect investors reacting to strategic partnerships or positive headlines that reinforce a company's positioning in a fast-growing sector like artificial intelligence. However, when zooming out beyond the single-day reaction, the longer-term picture has been more complicated. Over the past 12 months, total shareholder return has declined by approximately 16.07%, indicating that the stock has gone through a cooling phase after an earlier surge. That decline stands in sharp contrast to the company's longer-term performance. Over a 5-year period, Supermicrocomputer has generated an extraordinary return for investors, with the stock climbing roughly 8 times higher than where it traded half a decade ago. That type of multi-year growth trajectory reflects the company's rising importance within the broader data center hardware ecosystem, particularly as artificial intelligence workloads have dramatically increased the demand for high-performance servers, GPU-optimized systems, and scalable computing platforms. In many ways, the recent pullback may simply represent a period of consolidation after a massive run-up, rather than a structural decline in the company's long-term growth story. For investors who closely track the AI infrastructure sector, news like this partnership can often serve as a signal to widen the research lens beyond just a single company. Artificial intelligence computing requires a vast ecosystem of suppliers and service providers, including chip manufacturers, server designers, cooling system developers, data center builders, power management companies, and network operators. Because of this interconnected structure, many analysts recommend monitoring entire baskets of AI infrastructure stocks, rather than focusing on only one or two companies. At the moment, there are roughly 35 publicly traded companies that are commonly categorized as AI infrastructure providers, ranging from semiconductor giants to specialized server manufacturers and energy infrastructure firms. Scanning that broader list can help investors identify which companies are gaining traction, forming new partnerships, or benefiting most from the ongoing expansion of AI computing capacity around the world. Looking again at Supermicrocomputer's current valuation, the stock's price of about $32.65 still reflects the impact of the recent one-year decline. Compared with analyst consensus estimates, the shares appear to trade at a discount. The average price target across several research firms sits near $41 per share, suggesting that analysts collectively see some upside potential from current levels. In addition to the price target gap, the company's underlying financial growth metrics remain relatively strong. Annual revenue growth has been running near 19%, while net income growth has been closer to 33% on a year-over-year basis. Those are substantial growth rates for a hardware-focused technology company, especially one that operates in a competitive and capital-intensive industry. The key question investors are asking is whether the current share price represents a reset entry point after a cooling period, or whether the market has already priced in the most optimistic expectations for the company's future growth. Stocks that experience explosive multi-year rallies often go through phases where expectations, valuations, and real-world financial performance need time to realign. During those periods, even strong companies can see their share prices drift lower or trade sideways while earnings gradually catch up with earlier hype. Determining whether Supermicro is currently in that type of consolidation phase is one of the main debates among market participants following the AI hardware sector. One of the most optimistic valuation narratives surrounding the company suggests that its fair value could be significantly higher than the current market price. According to one widely discussed framework, the company's fair value could reach approximately $74.53 per share. If that estimate were accurate, it would represent more than double the most recent closing price of $32.65. Such a large gap between perceived intrinsic value and the current market price often reflects extremely bullish assumptions about future growth, profitability, and investor sentiment. Analysts who support that higher valuation argue that Supermicro could continue benefiting from the long-term expansion of artificial intelligence infrastructure spending. Their projections typically assume aggressive revenue growth over the coming years as hyperscale cloud providers, enterprises, and AI startups continue investing heavily in computing capacity. At the same time, these models often assume that the company can maintain relatively stable profit margins despite rising competition and supply chain challenges. Finally, they rely on a future valuation multiple that assumes investors will remain willing to pay a premium for companies directly tied to AI growth. In valuation models, even small changes in assumptions about revenue growth, operating margins, or earnings multiples can produce dramatically different fair value estimates. For example, if revenue grows faster than expected while margins remain stable, earnings could rise significantly over time, justifying a much higher share price. On the other hand, if growth slows or competition compresses margins, the final valuation outcome could look far more modest. That is why detailed breakdowns of valuation narratives often examine exactly which financial variables are doing the most work behind the scenes to produce those price targets. Beyond theoretical valuation models, the more immediate perspective often comes from brokerage research firms that regularly publish updated ratings and price targets based on company developments and market conditions. Recently, several brokerages adjusted their outlook on Supermicro, reflecting both the opportunities and uncertainties surrounding the company.